Afternoon, everybody. Thank you very much for joining in. So this is our July month webinar for Ambit 365. We will just spend, once again, I'll spend like in the last two webinars, because long short is a new product segment for the market. I'll just spend 2 or 3 minutes on explaining the product feature, the key aspect of the product feature, and then we'll move on to our monthly presentation. So we are a long short fund focused on absolute consistent performance across all market cycles. That's why all season. We aim to target 9 to 10% or 9 to 11% post fees, post tax returns on an annual basis, which means 18 to 20 or 18 to 22% gross returns before fees and taxes. So roughly half goes away in fees and taxes. We are a full tax product. And hence our positioning, what we like to say is it is debt plus plus, not debt plus or not equity minus. It is debt plus plus. Because fixed income returns post tax, post all expenses are around 5.5. Debt plus arbitrage are all in the 6 to 8 range. We target 9 to 11. So we are 200 to 400 basis points higher than the typical debt plus categories. We are lower than equity minus or enhanced equity strategies who also leverage. So how do we do this? 3 simple steps, and then we move on with our monthly presentation. One is we have 2 distinct buckets for our portfolio, stocks and Nifty. So we can go up to 180% gross exposure, of which 100 is stocks, 80 is Nifty. And the strategy that we follow in the 2 buckets are independent and non-correlated. So that's our primary risk management filter. The second major risk management filter is, unlike more aggressive products, our stock exposure fluctuates on and around 15 to 20% net long or net short. So this 100 is divided as 50 maximum long, 50 maximum shorts. And we try to keep the net exposure in plus minus 15, 17, 12% range. So for example, at this point of time, we are net long about 12%. We use a sine curve framework to pick stocks, which basically means that everything is a cycle, everything moves 3-5 sigma above the line of mean reversion and 2 to 3 sigma below, depending upon whether business is accelerating or contracting. In fact, we will talk a little bit more about sine curve framework in the context of winds of change today. So sine curve also believes that even investing styles and valuation styles can go through up and down cycles. We are currently in the midst of a cycle rotation, which we will talk about more. Nifty, we just use a series of mechanical parameters, series of mechanical indicators. We don't use any subjectivity there. We don't use any macro, political, interest rates, earnings growth kind of analysis. We just act on triggers, both on the long and the short side. That helps us manage the balance of the book on both sides. Sahil, if you could go to the next slide. So we started the product on October 6, 23. So we are literally in the 10th month at this point of time. June end, we completed 9 months, 1 week less than 9 months. Over 9 months, if you can see, we did a gross return of 12.7, which is on track with our guided minimum 18.5% gross return for the full year, which will give 9.25, 9.5 range post-tax, post-fees. So we are in the zone for that. June was a down month for us, minus 2. And I will explain how and why and what we did after that in the context of the June month. We are doing well. We are doing well in July. We have recovered almost all of the June losses in July so far. The book is up about 1.8, 1.9%. So there is a context to what happened in June, and the same context is relevant for what is happening to the book in July. So one of the things which I mentioned right at the beginning when I was describing the product was that we are a directional equities long-short fund. So while we are a long-short fund, we take directional bets. We use equities as an underlying. While we manage the risk by keeping stocks and Nifty in 2 separate buckets, while we manage the risk in terms of keeping our net equity stock exposure in the plus minus 15-20% range, we do take directional bets. And that will become more and more relevant in the context of our discussion for winds of change. So I will look back I'm just leaving the return discussion right here, not talking more about this. Once we talk about winds of change, I will come back and explain what happened in June, which we talked about briefly in our last webinar also, and what as a consequence is happening to us in July as well, and what could be the outlook going forward. So I'll roll. Next. So last 4 or 5 months, we've been continuously writing that the markets have turned extremely volatile, what we call non-linear markets. So we've been forecasting non-linear markets all through 2024 and maybe going into first half of 25 as well. But we saw volatility really spike over May and June. So May, just to recap, the first half of the month was weak. The third week of the month was very, very strong. And eventually the market sold off in the last week of the month to close almost flat. Our book did very well in May. We made almost 2.8% gross returns in May. June, the volatility went to an extreme crescendo. June stocks were rotating not on a weekly or a fortnightly basis, but literally on a daily basis. So one day it appeared like one particular sector is going through the roof. The second day it would just cool off. And typically, if you see these two statements, which is there on your screens, extreme high volatility and with extreme high turnover is a sign that people are losing confidence in whatever has been working so far, which is why at the first sign of trouble, people are trying to sell, exit, go through the rush through the exit door. And at the first sign of reversal, you come back running in thinking, oh, I will miss the bus. And that's what causes the volatility. And that's usually a precursor either to a top in the markets or a bottom in the market and a full trend change. Or sometimes it's a precursor for a sector rotation. So in this context, at this point of time, I think it's more of a sign of sector rotation. And the strategies which perform badly in certain market conditions that Peter Bernstein said can completely reverse and perform better in the next market conditions. So next slide. So we have illustrated how the volume spiked in the election week in the market. So November 23 till April 24, approximate daily market turnover was about 1.1, 1.2 lakh crores in the cash market only. June election week, it spiked all the way up to 2 lakh crores. And just to put things in context, 6 months average before November 23 was 80,000 crores. So 80,000 crores going up to 1.2 lakh crores, which itself was a sign of high churn, high volatility, lack of confidence seeping into the system, into whatever we were doing before this whole spike started. And it peaked out in election week and the whole month in June, almost at 1.8 to 2 lakh crores average. Sile next. So our last two newsletters and last two webinars have both been titled Winds of Change Part 1 and Winds of Change Part 2. In our previous webinar and newsletter, Winds of Change Part 1, we said we can see signs of trend reversals in a few sectors. We are not sure yet. We are introspecting. In Part 2, we have gone ahead and actually concluded that at least 3 sectors we are seeing trend reversals going forward and the reasons for the same. So here we will talk more about the part, which are those sectors where we are seeing trend reversal and why. Typically, so while I mentioned that high volatility is an indication of trend reversal, either in the entire market or at least the sectoral rotation, but it also needs a catalyst. So markets always rotate after a catalyst. So just to give you some of the previous examples, COVID-19 proved as a catalyst where suddenly the focus shifted to valuations, government policy shifted towards the beaten down sectors, and there was a lot of pump priming there. Suddenly the market rotated. Market rotated away from expensive quality names to cheaper PSU banks, PSUs, industrials, and capex plays. Before that, we saw a major catalyst, one in 2013, one big one in 2008. So 2008 crisis acted as a catalyst to shift focus away from the highly leveraged companies towards the asset-light, net cash, low leverage companies with high ROE and ROC, and that segment kept on doing well for the entire decade almost. So the current catalyst that we see in the market is not such a major one, but is still a catalyst. This was the Lok Sabha election results in the month of June. From a consensus of 280, 290, 300, 320, and maybe 400 par, of BJP actually landed in 240s, which is actually lower than 2019 seat tally. And that suddenly has made the market aware that everything may not be linear. Whatever appeared like a slam dunk, whatever appeared like a simple consensus, may not be so. So this is what is in chaos theory. There's actually a term called butterfly effect. It's very interesting. So the butterfly effect is jokingly often said as a butterfly flapping wings in the rainforest in Brazil can actually cause enough of a turbulence in the pressure that it can cause a storm in Texas. So that a small change occurring in one part of the ecosystem can have so much of linkage impact that it actually impacts in some other part of the ecosystem. So this whole risk focus that actually came up because of the election results did two or three things. One, things can go wrong. So suddenly market participants have started talking about margin of safety. Second, an analysis of elections actually showed that the ruling government did badly in constituencies which are more rural focused. So that brought forth a question that has the government ignored the rural economy while giving a huge amount of attention to the capex and the industrial side of the economy. And hence, will the government be forced to do something now for the rural part of the economy, considering 4 or 5 states are also due for elections in the next 1 to 2 years? Third, it also brought to the attention of the market, are we ignoring something? Are we just focusing on one side and ignoring everything else? Has the market become too lopsided? Sahil, next. So we are talking about three big trend reversals, which we are convinced about at this point of time. And we will talk about each of them in a slight amount of detail going forward. So one is IT sector. IT sector has been underperforming for about last 18 months. There are early green shoots available in the IT sector, which indicates that it has bottomed out and is turning up strongly. Second is FMCG, which is bottoming out of rural and semi-urban demand, small ticket items. And third is, has PSU banks and many other parts of the PSU space gone into a bit of a correction, consolidation, including maybe industrials, that kind of a phase. In some cases, we see a risk of 15 to 20% downside. In few cases, we can see a little bit more of sideways trading behavior over multiple weeks, at least if not multiple months, possibly multiple months too. And how are we positioned accordingly? So the markets suddenly have become valuation sensitive. I mean, in a particular sector, a particular space where growth was there, where government policies were favorable, markets had become slightly valuation agnostic. It has now started looking at where are the valuations with respect to earnings growth, where are the valuations of a particular sector with respect to another sector. Is it possible that there is a better risk reward in a cheaper sector at this point of time as compared to a relatively more expensive sector? Sahil, next slide. So this is the first one, IT sector. Two key reasons or two key green shoots that we see. One is, if you see the chart on the left, the net hiring trend has shown an uptick. This was visible in TCS earnings report as well. There was a net hiring for the first time this time after 3 or 4 quarters. In fact, you will see over the last few years, barring some small upticks, the net hiring has been quite weak. This was a fairly reasonable uptick. Even if you look at TCS QOQ revenue growth chart, it has, YOY constant currency revenue growth chart. It shows a meaningful uptick in this quarter. So it's almost like a nice reversal out there that we can see. Another very encouraging feature which we noticed in TCS results was that the BFSI segment, after being very, very weak for 3 to 4 quarters, has shown a clear sign of uptake. And BFSI is one of the large client segment for Indian IT companies. Uh, Last week, 3 or 4 large banks in the US reported results. They beat expectations by almost 17 to 18%. This year, the second best performing sector in the US after semiconductor and tech is actually banking. And typically, whenever banking stocks and banking earnings do well, they tend to spend, they tend to increase their discretionary spend. And Indian IT companies are obvious beneficiaries. Second is FMCG. Uh, FMCG volume growth has been continuously decelerating since mid of 21. There's a slight uptick which is visible on this chart, but actually it's not there in the data yet. It's reflected more in the commentaries. We have captured commentaries from 3 leading companies which has come out recently. All of them talking about a clear sign of a demand uptake in rural. Now, this is before the budget. This is before any government support. There is a very, very strong possibility, and we will know that next week, that the government should allocate some more money and some more resources for the benefit of rural economy. And the government has enough leeway because just before the elections, RBI gave a dividend of 2 lakh crores as against an expectation of just 1 lakh crores. So government can actually divert more resources towards the rural economy without actually tinkering with the fiscal deficit targets. So that's a very, very strong expectation. There could be some other policies in the budget, like increasing the minimum income tax threshold, which also benefits the consumption of the low ticket items. We are long both IT and FMCG sector at this point of time, with fairly convincing positions. We are looking to add more position to FMCG going forward. So this is the BSE, PSU banks versus BSE private banks relative price to book ratio. No, sorry, this is just the BSE PSU price to book ratio. This is at a 13-year high. It's not at peak, but it's at a 13-year high. The peak is still 50 to 70% higher than where it is today. But from literally a life low going to 10-year or 13-year high in such a short span of time can result in some bit of consolidation, some bit of correction, some bit of de-steaming, whichever term we may want to use. And we are looking at that at this point of time. A number of industrials also, in terms of valuations, are trading at 3 sigma to 5 sigma above their mean numbers. We will show some of the relative valuations on the next chart. Side. So in this chart, what we have done is like for the previous cycle, so 2013 to 20 cycle, Asian Paints was considered to be the poster child for quality names, the poster child for a fantastic consumer company. And all valuations were sort of benchmarked to Asian Paints. 21 onwards, we are seeing the resurgence of the capex cycle companies, and ABB has become the poster child of this cycle as the most diverse in terms of its product offerings and technologies, one of the best managed, one of the highest quality, and one of the names which across institutions people look at, because in the whole capex cycle, beyond the top 5, 7, 8 names, the quality starts to become a challenge. And hence we have just taken 3 names. So, the charts on the right and the 2 bottom, we have just taken 1 FMCG, 1 pharma sector, and 1 IT company's relative valuations with respect to ABB, just to show how stark it has become. So the top right chart is the P ratio of Infosys versus ABB. This is, I mean, the ratio has come down from 0.6 to 0.2, pretty much scraping the barrels of 2018-19 from where IT had actually taken off. The chart at the bottom left is HUL to ABB. This is actually broken through all lows, which also captures huge underperformance of HUL in the last few years. Chart on the bottom right, despite the fact that pharma sector has done reasonably well, Dr. Reddy's to ABB price to earnings ratio trailing is broken through 2018-19 lows. The chart on the top left, we are showing HDFC to SBI relative price to book, the price to book ratio. So HDFC's price to book used to be almost 5 times that of SBI's in 2017-18. Right now it's just 1.4 times. So this is this huge convergence, and we have been talking and predicting this convergence for quite some time. This huge convergence has now reached a level where it is possible that some of the private banks, if not all, can actually outperform PSU banks for a period of 6 months, maybe a year. So with this context, now I will touch upon for a minute on our performance for June and our performance for July. So up till June, we were steadfastly long on capex plays and PSUs. So capex plays, PSUs, and industrials. And we were steadfastly short on IT services and consumption and private banks. Because our view at that point of time, which played out really well, was that's a segment of the economy which is accelerating, so the upward sloping of the sine curve. Private banks, IT services and consumptions were decelerating, so the falling part of the sine curve. And that worked really well. So for if you exclude June, till May end, over 8 months, we had made 15% gross. In June, although we went into the month a little lightly positioned because of election results, suddenly the whole cycle started turning. We were still okay on a long book, but a short book, particularly which are short on consumption, IT services, etc., just took a huge knock within the first few days of June. And by the time we rebalanced, the damage was already done. So we've been talking about winds of change for the last 2 months. Our current portfolio is long IT services, FMCG, pharmaceuticals. We bought and sold one private bank, we're still holding the second private bank at this point, and a core position in SBI. Our short book is currently 2 industrial names. Our short book has 2 industrial names at this point of time. We have one PSU bank. We shorted and booked profits in one of the PSU names already in the short side. And this is working really well because now our portfolio is realigned to the current winds as it is blowing. There's been a major cycle rotation. We think the cycle rotation should play out at least for a few months, maybe for a full year. We don't know. We will have to watch it very closely. So, I mean, Rahul, will you talk about this slide and the next couple of ones? Give some examples of where we have placed our individual names on our sine curve framework. Where are we long? Where are we short? Illustrate that with a couple of examples. So just before I hand over the call to Rahul, just to give a brief conclusion once again, that this whole rotation in cycle, while we saw it coming, by the time we actually did our work, it did the damage for us in June, which in our style, because we are a directional long-short equity fund, this is bound to happen once every 12 months or once every 18 months or once every 20 months, broadly in that kind of a horizon, but not very frequently, because the sine curve framework is flexible enough to adapt to the next cycles, which we have done, which is why July is seeing a very, very strong bounce back. July, despite Nifty being up almost 2.5%, our short book is also in the money, slightly, but it's still positive. It's not losing money. Long book is obviously doing well. So Rahul, talk about the placement of various names on the sine curve. We don't need to go through all the names, give a few examples, and then a couple of detailed slides, which is after this.
Thanks, Dheeraj. Just one beautiful example from October till I think so till May month. One thing which was being long was the discretionary side of the portfolio, and short was on the FMCG side, basically the consumption. But from past 2 months, we are witnessing the complete reverse is taking place, as we have recently witnessed in past 1.5 months that Titan is witnessing decelerating growth rate compared to the peers, but due to various factors which is being mentioned by the company, and plus the competitive intensity or the organized share has been catching up the share. So that's why I think so Titan has been at the top of the channel. If you look at Titan's valuation on a TTM, has been surpassing the FMCG side of the way, world. Whereas FMCG in the past, from October onwards, since inception of the fund, we were witnessing a decelerating volume growth and a decelerating profitability growth. And suddenly, from past 1 month, the channel checks and the rural demand, whether in terms of the sowing data, whether in terms of the monsoon data, or whether more importantly, the low packs SKUs, which is driving the rural pace. So the space has completely reversed, and that's why we are witnessing FMCG, as you can see from the sine curve, has been now getting a steam and is on an accelerating path, and Titan is at the top of the channel. Same way, if you look at on a deceleration, because sine curve, we always say that it's an accelerating path and a decelerating path, and there are various factors attributed to the sector or to the company on the respective path. Like chemicals is one of the classical example from the past 6 to 8 months, where we are saying that throughout the world and in India, there is a higher inventory which is being built into the channel, and second, the destocking continues to be there. Prices are still holding lower. It has not yet seen a sign of a revival, and that is why we continue to witness it's a matter, it's into deceleration phase, last leg, I would say. But still the worst is not yet over, and this is being reflected in the month on month data of the chemicals channels. And one more thing, like we always used to say that in industrials defense, there are some pockets of defense where we will be talking that still the pace has yet to be done compared to the rest of the subsegments of the industrial, like BHEL. If you can move to the next slide, side. Like BHEL is one classical example of our sine curve framework, that how it is witnessing cyclical upturn. The basic reason, I would say, it's one of the outlier among the industrials, is because India is going through, I think so, in the past 15 years, we had not witnessed 8.5% CAGR power demand in the last 3 years, which is much higher than the actual real GDP growth rate also. So after a long time, we are witnessing the power demand is higher than the real GDP growth. And this gives a lot of impetus on the government to go for the higher power capex. You can see from the bottom chart that the kind of power thermal order inflow from past FY18 has been on a dry spell. And suddenly this was FY24 was one of the inflection point where the government has also started focusing, increased the visibility of the thermal tendering, moving from a 2 to 3 gigawatt to annually at least a 7 to 8 gigawatt. And what has changed BHEL particularly for this cycle? In the past cycle, if you can look from the above chart from March 2002 to March 2008, there were a lot of competitors. Today, I think so, among the whatever tendering has been done by NTPC, 85% of the tenders are being won by BHEL. Earlier, there was Chinese competitor, but this time those players are missing because of the government want to keep it to most of the domestic side. So this two factor is enabling BHEL to, if I want to give you a particular number, the power inflow for BHEL for the next 3 years is almost a 60,000 crore of inflows to take place. If I look at from FY18 to 23, it was just ranging around 115,000 crore. So it's almost a jump of almost a 4x kind of jump that would be taking place. And we have witnessed in the past that the moment order inflow starts taking place or accelerating pace takes place, in a matter of lag effect of a 1 2 years, the profitability and the PNL starts getting reflected. This is on a BHEL. I won't go into the diversification part because it still contributes only 10 to 15% of the overall book for BHEL, but definitely compared to its 20-year cycle, they are getting more focused on the defense and the railways that can act as a catalyst for the next 1 decade story. So can we move to the next slide? And this one story we would like to say on a short side. PNB, I would say, I would just want to give you a brief pass from October 2023 to March 24. we were long on a PNB, and if we look at the past 1 year in entire CY23, the best outperforming bank was PNB compared to within the entire banking industry. The best metric, how I would say the catalyst which was driving the PNB valuation and the outperformance was only the asset quality, where we were witnessing a higher recovery was 2 times higher than the slippages, and that was driving the profitability. But now moving from year onwards, the recovery would be on a lower path. And the most important thing which can makes us worry on the PSU bank is the ACL provision, which RBI wants to take it in a gradual manner, where these all PSU banks have a lower buffer compared to the private sector bank. Just to give you one best example, like we know SBI is a gold franchise among all, not only the PSU bank, but in the entire banking industry. Their ROE has been much better than the rest of the industry, whereas PNB ROE is almost half of what SBI is there. But still, the valuation gap is just in the range currently, if you look at, is at just a 40%. So this gives us that margin of safety which Dheeraj was alluding in the start of the PPT, that the margin of safety is very low currently for PNB when we compared with the SBI bank, and that is why it's one of our short name from past 1 month. Here we end the PPT.
Yeah.
You want to add something?